since you've had such a wide-ranging experience investing in Australia and overseas, a lot of our listeners haven't experienced, maybe March last year was the only experience of a market crash, and so many people have started investing post that point. And so there's a lot of people listening to the podcast that have never experienced much market volatility or a significant crash. And I'd love to hear a bit about your experience, the very first market crash you ever experienced, and maybe in contrast to how you went through March last year and how you'd approach a future market crash with everything that you know now, and maybe some of the things that we can learn from that.
Yeah, great. Thank you. A bit scary, all that wisdom I'm meant to have. So hopefully I live up to it. First crash, really simple. I just started in stockbroking in 1986, and it was obviously the 1987 crash. And I used to flick on my tiny television every morning, and Michael Pascoe would be on talking about US stock markets, and lo and behold, the S&P or whatever was down 25%. And the response was very much, got to the office, great boss. He goes, lads and ladettes, let's not stress out. This is not the end of the world. We are going to do some buying today. So basically that was the disposition in the research team where I was. We sat physically calculating PEs as share prices fell. So someone would yell out, Boral, whatever, what's the PE? Oh, that's looking really cheap. Oh, I guess it's more of a buy now. So it was one of the cases where the world was meant to end. We were meant to get a depression, but Alan Greenspan came in, and this was the first example of where the central bank, the Federal Reserve, moved in to drop interest rates to boost liquidity into the markets. Really, I think probably one of the most important crashes I've ever lived through is long-term capital management, which was a hedge fund, very, very famous in 1998. And LTCM was really important because it was renowned as being an experts in options and derivatives. They had two Nobel Prize winning people who created the Merton and Scholes options pricing model on their board. And they were a hedge fund that had come and made themselves like one of the top performers, okay, for hedge funds. And they'd been around for about 4 years. And this black box of trading that they had created was meant to be infallible. And what happened is that you had the Asian currency crisis in 1997. And I'm going to get round to this point again when we discuss some of the other international markets, because it's really important that people understand that the peg to the US dollar for emerging markets actually broke, and they all had high levels of US dollar denominated debt. So as their currencies collapsed, they couldn't service the debt, and you had this massive rolling contagion effect across Asia that started in Thailand. And ultimately that moved around to Russia, and Russia defaulted on its sovereign debt. And LTCM, this hedge fund, was very highly leveraged, and lo and behold, they had said Russia will never default on its debt. They started to go under. And at the time I was sitting with doing global emerging markets with a guy called Tim Love, who was the global emerging market strategist for Societe Generale. And he introduced this concept of systemic risk to me. Okay, and this is something that has come around recently with the Evergrande example in China. And why I want to point it out was up until that point, you really hadn't had a too big to fail example in financial markets. But 1998 was probably a pivotal moment where, again, Greenspan had to come in, put a lot of liquidity into the system. You had all the other major banks in America having to bail out LTCM. And it really set the precedent, which what became the big 2008 crash, and ultimately what we're seeing recently. And I guess the point of what I want to make about March 2020 was that it was quite an unusual crash. It was very quick. It was very severe. And what it showed yet again was kind of the fragility in the financial systems because of all the leverage. So in March, beginning of April, the Fed started to see that the markets became dysfunctional, okay, particularly in the high corporate debt yield markets. So you couldn't facilitate trades. And this again is due to hedge funds, all the positions, all the liquidity. They have redemptions. They then have to sell. If you can't sell, the market gets dysfunctional and equities get dumped. So it becomes a rolling sell-off. So what happens is in those markets, it is quite scary. But ultimately, the Fed came in, dropped interest rates aggressively, but also came in and bought junk debt and bought mortgage-backed securities. For me, how I manage my money in that situation, I do get a bit nervous because I'm older and there is some capital protection. So what I tend to do is that I did take some money off the market in the beginning. Once the market stabilized, once the Fed had stabilized it, I went back in and bought reasonably aggressively. So I hope that kind of gives a synopsis of kind of where we are with crashes and the financialization, as I like to call it, of markets at this point in time.
Can I ask a question just to double click on something there? You mentioned this idea of systemic risk. Can you just explain for listeners that don't know what that means? Can you explain what systemic risk is?
Yeah, absolutely. So it means I have a chart that I can show later on, but once upon a time, we were all ring-fenced, okay? And I'm going to give the example of mortgage lending here in Australia, okay? So the banks, they lend to you and me. We have a mortgage. Then we, in turn, pay off that mortgage, but that mortgage product is then repackaged as mortgage-backed securities, okay? And they're one of the biggest corporate bonds or that can be bought here in Australia. So if you go in and you happen to buy not only equities, but you buy corporate bonds, which I have done in the past, you are given a lot of options to buy mortgage-backed securities from not only the banks, but also Liberty, Pepper, all those other providers. Also, as an investor, you can buy Commonwealth shares, NAB shares, etc. Okay, so what I'm drawing is the triangle here of the exposure to the property market. So if you get a property market crash or a company that is in trouble, like Evergrande in China, it means that the tentacles of the wealth effect go out. It's almost like it's not accelerated, it's multiplied. And this is the problem. There's been so many financial products that come off of one single loan. Let's say that can be amplified 5 times. And because all of us have an exposure to that asset, it means that the world now, when you have a lot of debt in the system, and when it's amplified out into the community in terms of our wealth, when the system starts to shake, it becomes a systemic problem. So it's not just isolated to a bank. It means that you and I and the super funds and everyone else is exposed. And the classic case in point was when you had, first of all, you had Bear Stearns went down, and one of the reasons supposedly they didn't save it in the GFC is that they refused to bail out LTCM some 10 years earlier. But when Lehman's went, everybody started to panic because they owned a lot of those collateral debt obligations, those mortgage-backed securities in the US, which had been on-sold, resold 5 times. And to understand that, it's worth watching The Big Short again. And then the whole banking system, people started to panic and felt their deposits were at risk. So you had potentially a run on the banks. Now, this is an extreme example, but in the case of Evergrande in China, where people have been jumping up and down, is that because the Chinese economy has 30% of its GDP is related to property, and everything's highly leveraged with a whole lot of shadow loans. So it's very hard to ring fence just one problem. Now in China, they will ring fence it because Xi Jinping does not want the whole system to go down, and he wants to protect the wealth of the people because 40% of the wealth is held in property. So hopefully it's the interconnectedness now of how much financial assets we own and how much of our economy is related to finance, if that makes sense.
Yeah, it does. And I think a lot of people especially people that don't really understand how debt works, in particular, because they think about the stock market as a cause of a lot of issues, but they don't necessarily understand that there's this underneath the surface of the stock market, there's a debt market, which is where things like bonds are, and that is far and away massive compared to the actual stock market. And so that's typically where the party ends, underneath the surface. So that's really fascinating. We've never covered that on the show. So thank you for kind of being a field guide there.